This program was made possible in part by the Schumann Center for Media and Democracy, the Nathan Cummings Foundation, the Consumer Trusts Fund, the Gilliland Family Fund, Paul Newman, Bernard Rappaport, the Brightman Hill Charitable Foundation, and Edson W. Spitzer. Frontline is made possible by contributions to your PBS station from viewers like you. Thank you.
What we demand is integrity and honesty.
Last week, regulators hit Wall Street with its biggest fines ever.
What is not tolerated, however, is fraud.
Tonight on Frontline, the story behind the fraud that cost investors tens of billions of dollars.
I was robbed, I was lied to, I was stolen from.
It will be years and years before I ever get over what's happened.
They were duped. They believed the research, they bought the research, they bought the stocks based on the research.
Correspondent Hedrick Smith goes inside Wall Street, investigating the scam.
It was brazen. The evidence of it was overwhelming.
Uncovering the hype.
We called that the $1 trillion fib.
Exposing the hidden connections.
This is a mortgage for $1 billion.
And digging into Wall Street's biggest bank.
This is hubris in the worst sense of the word. Who do they think they are?
Tonight, how Wall Street fixed the game.
The committee will come to order. This hearing of the Committee on Financial Services will begin, and as you all know, we have a number of witnesses to hear from today.
Mr. Chairman, I just ask unanimously that my opening statement be entered in the record.
Without objection, all these statements are made part of the record. I would ask the witnesses to rise. Raise your right hand.
An all too familiar scene.
Do you swear that the testimony you are about to give is the
A corporate CEO hauled before Congress, called to account for cooking the company's books.
You're sworn in.
Over a decade, Bernie Ebbers' WorldCom was America's hottest telecom stock. It got as high as $96.75 a share. Now it's worth just pennies.
Mr. Ebbers, you're the former CEO of WorldCom, is that correct? Mr. Ebbers?
Instruction of counsel, I respectfully decline to answer on the basis of my constitutional rights.
What I would like to know...
WorldCom was the most costly business scandal in the U.S. history.
You sleep well at night, Mr. Ebbers?
Respectfully decline to answer on the basis of my Fifth Amendment constitutional right.
Corporate fraud. That's the story we know. But the real story behind WorldCom's stunning rise and fall is more sinister. It's a story of pervasive corruption here on Wall Street. How brokers and analysts shaped and hyped the telecom boom, pocketed enormous profits, and then took millions of ordinary investors on a catastrophic ride. $2 trillion in losses on WorldCom and other telecom stocks. So before you bet again, watch as we peel back the layers and look inside the culture of Wall Street and the world of investment banking, and examine the minds and the motives of the analysts.
To understand Wall Street's role in the WorldCom story, I headed south, seeking clues to how things went so terribly wrong. I found an all-American story. Entrepreneurs starting from scratch, raising money from friends and neighbors, and riding the incredible tide of telecom. The story begins here in the quiet backwater of Brookhaven, Mississippi, where I met the man who gave birth to the idea that it would become WorldCom, small-town businessman Murray Waldron.
You have some experience in telecom, right? Not much, but you had some.
Yeah, not much. You're right.
Are you a businessman or are you an engineer?
No, neither one. Well, I had been in several different kinds of business. I was in the grocery business, used car a lot, just different things.
With the breakup of AT&T in the early 80s, Waldron saw a golden opportunity to sell cheaper long-distance service in places like Hattiesburg, Mississippi.
I went in the Chamber of Commerce office. Lady asked if she could help us, and I said, yeah, you can tell me how many long-distance companies you have that service Hattiesburg, and she said, what is that? And I said, never mind, we're at the right place. So that's where
They didn't even know what long distance was.
No.
Waldron hooked up with Dave Singleton, who'd raised money for various local ventures, including some motels run by the man who would eventually make WorldCom a household word, Bernie Ebbers.
Bernie was a friend. He was a friend both in the church and in business. We had been involved in some of his motel things together.
Ebbers grew up in Canada, came to Mississippi for college in the 1960s, and stayed. He became a high school basketball coach, and then tried his hand at business with some church buddies.
Well, I actually started my working life as a bouncer in a bar, but I don't like to say that publicly.
He knew how to manage and enjoyed managing a profit and loss statement. Revenue in, control of expenses, and driving it to the bottom line, looking for good margin. He ran a very tight ship with his motels in terms of controlling his cost.
Ebbers saw an opportunity when Singleton suggested investing in Waldron's long-distance telephone company. Ebbers and his partners got a $650,000 loan from a local bank to buy a computer switch to route long-distance calls.
And what do we got here?
That's the switch in Hattiesburg. These about the size of 4 big oversized refrigerators standing there. We had a service that was good, that would save people money. And at that time, people were paying a lot of money for long-distance phone calls.
Long Distance Discount Service, or LDDS for short, offered cut rates to small businesses. They could do that because AT&T was under court order to lease its phone lines cheaply to startups like LDDS.
So you're reselling?
That's right. That's basically all it was.
Reselling and marketing, but not building, no big overhead.
That's exactly right. The telephone business, as we came into it back then, was not asset-based, but you didn't have to have a huge amount of equipment. So it was just a huge cash flow stream.
Anybody could start up a company, and people did. There were almost overnight, some 400 companies were established. Didn't exist before that. By people that said, well, gee, here's a chance to do something. Here's a great opportunity. It was better than the gold rush.
One of those who signed on early to Ebbers' gold rush was Lisa McAdams.
Yeah, here's some things I pulled together in 1988, which was the year I was hired. And
It paid off handsomely. Hired as a technician, McAdams worked like crazy, won Ebbers' confidence, and wound up as a WorldCom vice president.
It was exhilarating. I mean, we knew we were doing something very unique in this country. I mean, it was growing, it was building.
Ebbers grew his business the same way he built his motel chain, buying up regional rivals one by one.
As we grew into the adjoining states. We grew out from the Mississippi, Tennessee area, and we just kept expanding out further.
Ebbers' currency for the buyouts was LDDS stock, selling in the late 1980s at a couple of dollars a share.
Bernie Ebbers was a roll-up artist. And what that is he realized if he took a fragmented industry and he rolled it up, essentially rolled the revenues into one big pot, he could dramatically lower costs. That's the simple math of Bernie Ebbers. He was a roll-up artist.
Within 10 years, Ebbers rolled together 30 companies. Sales reached nearly $1 billion. The original plan was to sell out.
It didn't work out because the thing was making money. And then it just kept on growing and getting bigger and bigger and bigger. It was a great feeling. I mean, you talk about an old country boy's dream, it was a dream, I'll tell you.
But country boy Bernie Ebbers now had bigger dreams. He renamed his company WorldCom, and when Congress threw competition wide open with the Telecom Act of 1996, Ebbers went hunting bigger game. And his timing was right. The dawning of the internet age was transforming Ma Bell's old-fashioned phone network into the backbone for the World Wide Web and the high-tech channel for rivers of data flowing across corporate America.
There was thought that the information superhighway was going to be enormous. There was going to be a huge build out everywhere in broadband to every doorstep of every business, every doorstep of every house. And so it looked like an upgrade that people were beginning to think would be $300 to $500 billion in build out.
A potential gold mine for Wall Street banks.
What's their role in the whole telecom bubble, the investment banks?
Well, they were really the glue that brought it all together. They were the enablers. If you didn't have Wall Street, you wouldn't have had a bubble because you wouldn't have been able to bring together all the pieces necessary. The hype, the analysis, the credibility, the distribution system, the smarts, it wouldn't have happened.
And the money.
And the money.
Big, big money.
Big money.
To outsiders, Wall Street is overwhelming in its power, its immensity. It is the Mount Olympus of finance, deciding the destinies of legions of companies like WorldCom.
52. You want me to give you a list of the prices?
Wall Street's huge investment banks are the engines that drive corporate America.
50 to 60.
555. And it's growing. It's growing.
They raise the money to finance corporate mergers, sell corporate bonds, bring hot new companies public.
25, I could even do 30.
And their brokerage houses market stocks to investors.
We want to be 100% invested, and we think we have the right sectors by overweighting telecom and tech.
To most of us, the face of Wall Street is the market gurus.
To look into the future of communication services, you need several assets.
The research analysts keeping score on corporate America.
We rate shares of WorldCom a buy.
Coaching investors on winners and losers.
I originally thought to myself, gosh, what do I know about stocks and the stock market? So I thought, let me go out to a really reputable brokerage firm that I could trust. And so I picked Salomon Smith Barney.
At Salomon Smith Barney, our research analysts have the resources and determination to find the year's most promising stocks.
People are relying on Wall Street to sanction, to give them confidence in what they're investing in. Wall Street is like the seal of approval from Good Housekeeping for a consumer product. If Wall Street says this is a viable company worth investing in, if Wall Street says it's worth X amount of money, people assume it's acting prudently, soberly.
That's a great looking watermelon, Athena.
George McKellis runs a family restaurant in Houston. Like millions of others, McKellis put his faith in market analysts. He invested almost $300,000 of his portfolio in telecom stocks to pay for his children's college education, relying on advice from his broker.
He would constantly refer to a guy named Jack Grubman. Never heard of the man before in my life, but he would say, this is Salomon Smith Barney's top analyst. He is the man. This man eats, sleeps, drinks, breathes telecom. And if this man says to buy something, we need to listen to him and we need to buy it.
On Wall Street in the 90s, no one had a nose for telecom like Jack Grubman.
He has generated a pile of cash for Salomon Smith Barney.
Grubman knew telecom from the inside. He'd been a math and marketing whiz at AT&T for 8 years before moving to Wall Street.
He had the industry contacts. He was friends with most of the CEOs. He was very well connected within the industry. So he really worked the system very well.
But Grubman wasn't really doing what George McKellis thought.
The analysts morphed from being the serious, almost nerd-like students of numbers and corporate strategies into being hyper salespeople as an adjunct of the investment banking departments of the firms that employed them.
Analysts like Grubman were not really working for investors. They were the bird dogs for the banks, sniffing out hot new corporate properties.
Grubman said on television that he first picked up Bernie Ebbers at LDDS in 1986.
Absolutely. Absolutely. Now, as you know, 50% of all businesses fail in 5 years. This is the risk Grubman had to take if he was ever going to be great. And every analyst has...
What was the risk he was taking? Explain it to me.
The risk of going down there, finding a guy in cowboy boots in Jackson, Mississippi, in a pool hall, and saying this guy is going to be great. He is going to do something on the street, and if I hitch my career to him, this could make my career.
Getting to know WorldCom meant getting to know Bernie. And that meant hanging out with Bernie in his favorite local haunt, the Cherokee Inn.
It was a great place. It was a great place. It's a dive where people over the years have taken their knife out and carved in their girlfriend's name, and there's only 1 or 2 pool tables in the place. Really cheap burgers and beer, and you sit around and chat.
Grubman wasn't just playing pool. He was shooting for a jackpot with Ebbers and WorldCom.
They're in a generally capital-intensive industry, which means they'll be raising lots of money, which means lots of banking fees. They are going to be doing lots of acquisitions, which is lots of M&A banking fees, okay? They're in this growth industry of telecom. This is the mother lode for Jack Grubman. That is the dream of every analyst, to be able to do what Jack did.
On Wall Street, Grubman personified the New Age analysts, the power brokers who connected companies with banks and banks with corporate decision makers. These close links between stock analysts and Wall Street's corporate clients were the focus of a 2-year investigation by New York Attorney General Elliot Spitzer.
What we found was that analysts were involved from the very beginning of the investment banking relationship, going out there soliciting the client, promising that if you bring your business to our firm, we will take your company, proclaim to the world that it is the best thing since sliced bread, take your company public, keep a strong buy on your stock, and become part of your management team.
Gone was the very idea of independent analysis for ordinary investors.
And the companies say to the analysts, look, we'll choose your employer, but we expect coverage. And what they mean by coverage is they expect that analyst to write favorable research reports about their company.
So there's a quid pro quo.
There's an absolute quid pro quo. And coverage means we're going to promote the heck out of your stock.
But if that's how an analyst like Grubman worked, where did that leave investors?
It means you're turning your back on one set of clients. That's what he did. That's what the analysts were doing when they played ball just with the investment bankers.
The people who got hurt were the investors, the ordinary investors.
It was the ordinary investors who didn't understand the game.
40 million.
A game with huge payoffs for Wall Street banks.
We've got 100 million.
43 million. 50 million to go.
There were billions of dollars in investment banking fees generated by the telecom sector. It was the sector where there was a vast infrastructure being built, vast amounts of capital being raised to build it.
How much?
The banks were the midwives, selling multi-billion-dollar deals to companies and then getting investors to finance them.
Ciao.
Generally, the ideas come from investment bankers. They're the ones out there that are thinking of deals because they're the ones that will benefit from a deal.
So as Ebbers was gobbling up companies one after another, Grubman was whispering in his ear, egging Bernie on.
You had a very small player that came from nowhere with a CEO that did not have a technical background, did not have a financial background, and did not have an industry background. And he was being catapulted into number one. You couldn't do without a lot of help.
Jack Grubman and Salomon Smith Barney were essential enablers for WorldCom to take off. It took a rising stock price, it took some very good investment banking and some very good salesmanship in order to sell the marketplace.
And the marketplace for big money was selling institutional investors, pension funds, mutual funds. And in that league, Jack Grubman was the Pied Piper of telecom.
Could Jack Grubman move markets? Absolutely. Unqualified. Yes. Did people believe him? Yes. Was he very good at putting together the details? Did he know the business? Did he understand the players? Did he understand investors? Yes to all of those.
Rob Gensler, as manager of the telecom portfolio for T. Rowe Price Mutual Funds, heard many a pitch from Grubman.
Jack Grubman was a shoe salesman. The shoe salesman wants you to buy the shoes, and in fact, they want you to buy the more expensive shoes. Not to take anything away, but they are selling stocks, they are selling ideas. And one should never forget the term selling. Like all salespeople, they'd like to sell you what profits their organization.
Grubman's prime selling turf was the annual gathering of telecom's top tier at the La Quinta Resort in Palm Springs, California. They came for Salomon Smith Barney's annual telecom conference.
All the major players wanted to be there. As a telecom company or CEO, you wanted to be on the stage because the audience, in terms of the institutions, was fantastic.
They came to be seen with Jack Grubman, who was mobbed like a rock star.
Jack was the one who gave out the invitations. He decided who was going to speak and whether you were by yourself or on a panel. So Jack pretty much set the agenda. Jack also did lots of the introductions.
So Jack is the Johnny Carson?
Jack was Johnny Carson, in that he decided who he was going to have on his show and where they were going to sit. And Bernie Ebbers, at least in the couple conferences I remember, always had a very prominent position.
But Grubman did more than give his favorites the spotlight. Salomon awarded them sweetheart deals so hush-hush that even insiders like former Salomon Smith Barney broker Phil Spartus were kept in the dark. Spartus, who was dismissed and later sued Salomon, used to manage personal stock option accounts for WorldCom's top brass. But one thing puzzled Spartus. He had all the WorldCom executives except Bernie Ebbers. So in August 1999, Spartus called Ebbers' personal financial manager to solicit Ebbers' business and stumbled into a surprising discovery.
He said, well, Bernie already has an account at Smith Barney. And I said, what do you mean? He said, well, he's had an account for over a year in LA. And I said something to the effect, with who? And he said, with Rick Olson. I said, Rick Olson, who's that? He said, well, he was referred to Bernie by Jack Grubman. He's one of Jack's boys.
What Spartus had discovered was Salomon's exclusive boutique brokerage in Los Angeles, run by Rick Olson and his former deputy, David Chacon, who was forced out after blowing the whistle.
At one point, our clients collectively controlled, according to Olson, over $100 billion in assets. You probably had, 8 to 10 billionaires as clients under one roof.
Salomon's strategy, Chacon said, was to win telecom banking deals by giving personal windfalls to corporate VIPs, a strategy guided by Jack Grubman and run by a team nicknamed the Telecom Mafia.
The point is, if you can dominate the relationships within a sector that's tremendous in size and scope and has very few individuals whom you need to use as a pawn to accomplish your objective, well then, you have a winning business plan.
The crown jewels were shares of hot telecom IPOs, or initial public offerings. Premium clients got huge IPO allocations of new companies on the first day of trading and made a killing.
These shares would rise by 30, 40, 50, 100% the first day. So that in itself is free money. But Salomon took it to another level. Oftentimes, they did not allocate these shares until after the stock had been trading. Salomon would be able to call these same officers and directors saying, look, I have 20,000 shares of this company. It's trading at $85 right now, and wanted to give you, the opportunity to invest at the IPO price.
Which is much lower.
$15, $20. It allowed the Salomon Smith Barney to buy people, to buy their decisions, to buy their influence, and to buy their business.
By handing them free money.
By handing them free money.
The company reported to Congress that Salomon had handed Bernie Ebbers $11 million through 21 IPOs. But David Chacon recalls hearing from his boss, Rick Olson, who handled Ebbers' accounts, that Ebbers made far more than that from IPOs. Just one example, a company called Rhythms Net Connections, which Salomon took public in an IPO in April 1999.
Well, several days after the stock was trading, I sat right next to Rick. He said, well, between us girls, and what that meant was, that's kind of telecom mafia lingo for this doesn't leave the room. Bernie Ebbers just got 350,000 shares.
Now, are you sure he said 350,000 shares?
I'm sure he said 350,000 shares.
Olson would not talk to Frontline, but Chacon, in a lawsuit disputed by Salomon, said that Salomon gave Bernie Ebbers an immediate kickback of $16 million on that one IPO.
This was a well-orchestrated con game, meaning that here's this group of elite telecom executives that were given preferential treatment in IPOs and loans and other things so that the firm could generate their banking business.
Wall Street, like telecom, was booming. Salomon's profits from WorldCom's investment banking business were huge, but they wanted more. What if Salomon merged with a commercial bank like Citibank, so as one bank, a superbank, they could handle all the needs of a cash cow like WorldCom?
If you're Citicorp, you see WorldCom as a meal ticket. It is the perfect, quintessential client. They have tons of investment banking needs and tons of debt needs. You can't find a better client than a telecom serial acquirer.
If one man understood the potential power of a superbank, it was Sandy Weill. Weill began on Wall Street as a stock runner, and over 50 years made himself the street's dominant banker. Like Bernie Ebbers, Weill is a deal maker, a master of the merger, the bold buyout. Like Ebbers, Weill is an imperial boss, a ruthless cost cutter, driven to be king of the hill. And now, a billionaire. As a superstar among New York's financial elite, Weill was crowned in 2002 as CEO of the Year. His crowning glory was putting together Citigroup, the largest financial institution in the world. 250,000 employees in over 100 countries. But it almost didn't happen. For smack in the way of Weill's superbank stood a 1930s law that prohibited commercial banks from selling securities. The law was called Glass-Steagall.
Glass-Steagall was enacted to respond to some of the scandals of the early part of the century, where individual investors were grievously hurt by banks who were promoting stocks that were of interest to the banks rather than to investors. And that was a very sensible division of investment banking and commercial banking.
For decades, the big banks had pushed Congress to repeal Glass-Steagall, but Congress had refused. Then in 1987, the big banks got a break. Wall Street's own Alan Greenspan, a critic of Glass-Steagall, was named chairman of the Federal Reserve Board. Greenspan favored greater deregulation to help U.S. banks compete with big foreign banks, and he found room to reinterpret existing law.
Alan Greenspan is central to the change in banking that we saw in the 1990s. By looking at the loopholes, Alan Greenspan began to allow commercial banks, including Morgan at the time, and Citibank, into the corporate securities business on a limited basis. And that began to increase as the 1990s rolled on.
Greenspan let banks do up to 25% of their business in securities, enough for most, but not for Sandy Weill. As head of Travelers Insurance, Weill bought Salomon in 1997 and then set his sights on the biggest commercial bank, Citicorp.
We are talking about the largest financial merger in the world. We are talking about, for the first time in the modern history of the United States, since 1933, the largest bank, one of the largest securities firms, one of the largest insurance firms being put together under common ownership.
But that was against the law, so Weill privately lobbied Greenspan, Treasury Secretary Robert Rubin, and President Clinton. Then he made a breathtaking announcement.
I think what we are doing is creating a model of the financial services company of the future that will be...
And here you have the leadership, Sandy Weill of Travelers and John Reed of Citicorp saying, look, the Congress isn't moving fast enough. Let's do it on our own. The heck with the Congress. Let us affect this. I mean, this is hubris in the worst sense of the word. Who do they think they are? Other people, firms cannot act like this.
It was a brazen gamble, upstaging Congress, but Weil had made a deal with Greenspan. The Fed gave temporary approval for Weil to operate his superbank for 2 years, and if Congress repealed Glass-Steagall within 2 years, Weil was home free.
I think it's pretty clear to say that Sandy Weil forced the hand of Congress. I think it's equally clear to say that the Fed forced the hand of Congress to do something that they knew full well could not be done. What they said was, at the end of 2 years, if you haven't gotten it done, you will have to disgorge. But everybody up here said, oh my, we can't do that to our dear friend Sandy Weil.
Congress relented and finally buried Glass-Steagall by repealing it in November 1999.
The repeal of Glass-Steagall was a big deal because it enabled kind of colossal combinations that just weren't envisioned before. Where you brought the savvy of an investment banking house of like a Solomon Smith Barney together with a Citibank. And Citibank could loan an enormous amount of money.
So Sandy Weil and his team can market across the board to Bernie Ebbers. You don't need to go anywhere else, Bernie.
It's a one-stop shop strategy. It's very powerful.
I found evidence of the new powers of the superbank in a surprising place. Among these Mississippi pines. Land records show that these pines belong to a company called Joshua Timberlands, a company controlled by Bernie Ebbers. Ebbers bought nearly 500,000 acres of timberland sprawling across Mississippi, Alabama, and Tennessee in late 1999, thanks to Sandy Weil's superbank, which arranged the loan and gave Ebbers a $1 billion mortgage.
This is a mortgage for $1 billion. It's a mortgage that Joshua Timberlands, which is the Ebbers-controlled entity, got from Travelers, the Citigroup unit, in February of 2000.
Is it conceivable that a loan of this size could be made to Bernie Ebbers through his entity, Joshua Timberlands, without the chief honcho at Citigroup, Sandy Weil, knowing?
Not the Sandy Weil I've read about.
Attorney Sean Coffey has sued Wall Street banks to recover $300 million in WorldCom losses for the pension fund of New York State employees. One thing not disclosed to investors, he says, was that Weil's superbank became Bernie Ebbers' business partner in the timber deal.
I think the average investor would like to know, well, is there something here about the relationship between Solomon, or its parent, Citigroup, and the people at this company which should give me pause about how objective they are being?
The whole deal was kept sub rosa because it didn't look good on Wall Street for Ebbers to sell WorldCom stock. So the superbank devised a scheme to help Ebbers convert his WorldCom wealth into hard assets. Don't sell stock, take a loan.
So here you have Bernie Ebbers getting cash in his pocket by virtue of getting a loan from Travelers to buy this timberland and then turning around and selling part of it for cash.
Timber was just part of Ebbers' private business empire. Luxury yachts, a boat building company, a lumber mill, a ranch in Canada. Not just any ranch, but the biggest ranch in all of Canada, 500,000 acres, financed with a $43 million loan from Citibank. And the superbank's loan, Coffey says, was backed by 2.3 million shares of Ebbers' WorldCom stock.
That's a very troubling link in our view, because Citibank has an interest in the stock price of WorldCom being high enough to cover the loans they've made to Mr. Ebbers. And yet in another part of the same building, you've got Jack Grubman issuing analyst reports saying, buy that stock to drive the price up.
So Ebbers, WorldCom, Grubman, and Weil's superbank had become so intertwined that the ordinary investor was lost in the trees.
Another record day on Wall Street, another few points closer to the magic mark of 10,000.
The Dow soared 184 points
The Dow finished above 11,000 for the first time today.
As the new century approached, it all looked so good. It seemed as though the raging bull market would never end. Wall Street can be deceiving.
Well, I think Wall Street is distinctly different than every other part of the economy because Wall Street, in the end, deals in fantasies. They trade in the promise. And when the trading and the promises get completely out of hand, and Wall Street is really just dealing in phantoms, that's where the danger comes.
The real danger for WorldCom and its investors began with its biggest deal.
Some very big business news tonight. The battle to take over this country's second largest long-distance telephone company, MCI, has been won by that upstart, WorldCom.
It sounded great, taking out telecom's number 2.
WorldCom, the record-breaking $37 billion deal, that's with a B.
But was Bernie Ebbers overreaching?
It was the goldfish swallowing the whale. I mean, WorldCom was nowhere near the size of MCI, and it surprised everybody that they had the audaciousness to try, and they pulled it off.
Ebbers dared because the superbank engineered the deal. Jack Grubman was so involved that the WorldCom board listed him as a financial advisor. Grubman wouldn't talk to Frontline.
Thank you, Mr. Grumman.
But he did talk to Congress.
Did you ever attend a board meeting for WorldCom?
Yes.
Is it rather unusual for analysts to attend board meetings?
It is rare, as it has been for me over the years.
Grubman was giving Bernie Ebbers guidance on corporate strategy.
His point of view on the industry was that the best way to be successful was to build out the biggest global network possible. So suddenly you heard Bernie starting to talk about the same thing. It was a completely different strategy than what he had talked about prior, a few years prior.
A strategy that turned sour because it was based on a wildly inflated premise for the whole telecom boom.
WorldCom said that data traffic, the thing that everybody was interested in, was doubling every 90 days. At one point, data traffic was doubling every 90 days. But what happened is WorldCom repeated it and kept repeating it. And so for 3 or 4 years, that became the mantra, and it just was flat wrong. Data traffic hadn't been growing at that rate since at least 1997. So the hype was a lie for 3 or 4 years before it burst.
That phantom mantra, Cleland says, powered a $1 trillion increase in the stock of 14 core telecom companies. That evaporated when the bubble burst.
We called that the $1 trillion fib.
So you call it a $1 trillion fib?
Yes.
They knew it was phony?
Oh, I think the companies knew that data traffic wasn't growing that fast.
There were very few faint voices that were saying it was wrong. But by then, everyone was listening to the upside story. And why shouldn't they? They were all making so much money.
WorldCom was a gravy train for almost everybody. It was a gravy train for the investment bankers. It was a gravy train for the stockbrokers that were advising it. It was a gravy train for investors who owned it and benefited for its skyrocketing stock price.
For Salomon Smith Barney, the gravy train delivered more than $1.1 billion in investment banking fees from the telecom sector in just 4 years, roughly $140 million from WorldCom.
How much financially you have benefited from working for Salomon Smith Barney.
Big bucks for the banks meant big money for Grubman.
I've been compensated over the past 4 years roughly $20 million per year on average, but that is not tied to any one company.
But to his bosses at Salomon, Grubman justified his huge pay bonuses as rainmaker for the bank, deal by deal, company by company, claiming credit for landing $1 billion in bank fees between 1998 and 2001.
He didn't argue, pay me as an analyst because I'm a good stock picker. He said, pay me a lot because I bring investment banking revenue to the firm, in essence by promising those firms that I'm going to push their stocks.
Even when WorldCom's stock hit its peak of $96.75 a share, Grubman kept pushing it, predicting it would go much higher.
WorldCom, it sounded very, very good. I invested a total of about $32,000 in it. I was planning on that doubling for my old age.
My broker said, look, these people are saying buy these stocks. These stocks are good to buy at this time. And so I trusted him when he told me I was listening to the best and the brightest analyst in the world.
But at Grubman's telecom bash, insiders were getting drastically different advice on the market.
It was January of 2000, and I was at the Solomon Smith Barney Media and Telecom Conference, and we were at a very big dinner that probably housed 500 people.
The market's flying. We just had a year where telecom stocks doubled.
And then suddenly Bob Rubin shows up.
Bob Rubin, former head of a major Wall Street firm, then Clinton's Secretary of the Treasury, had just become Sandy Weil's chief lieutenant at Citigroup.
And then we'd had some wine at the dinner, and then Bob opens up saying that Sandy Weil had asked him not to give the speech.
But Rubin gave the speech anyway.
And he suggested in no uncertain terms that the stocks were way too high, they were in levitation zone, and they couldn't be sustainable. So as he was speaking, my palms were sweating. He was making the case that there was a bubble. There was an internet bubble, there was a telecom bubble, and this is three months before the internet bubble collapsed. So he gave every investor in this room, which was every investor on the planet that mattered, 3 months to recalibrate and to get out of these stocks.
And privately at his table, I was fortunate enough to be at his head table, but he told us that he had no money in the stock market. I wish I had taken his advice, and I think there's a lot of other guys at the table that would say the same thing.
Did you talk to Grubman?
I did talk to Grubman afterwards. My hands were shaking. I said to him, "What'd you think of Bob's speech?" And he goes, "Stocks go up, stocks go down, doesn't matter." He was completely blowing it off.
What's more, Grubman kept pushing Bernie Ebbers to maintain the image of growth momentum and reach for the moon. But the regulators blocked him.
Today, the WorldCom Sprint merger became the biggest deal ever to collapse.
The beginning of the end for WorldCom was when he couldn't buy Sprint. Because how WorldCom kept this story going is they would have a big acquisition, and then they would do the accounting magic where they hid what was going on, and then they'd move on and operate until they had the next merger.
And it looked like your company was growing beautifully, and it looked like all your costs were under control. And underneath all of this, you really weren't merging companies.
So what happened is when the Sprint merger was denied, the beast couldn't get fed again. They didn't have another opportunity to cook the books.
Long-distance prices were plummeting. Telecom hype had produced a glut of overcapacity. Some analysts warned investors to get out.
And we came out with a call that said that the revenues are shrinking and that these companies are not going to be able to cover the cost of servicing their debt.
So you said underperform.
We said underperform, which was sell.
With WorldCom stock tumbling, Bernie Ebbers was in trouble. The company was desperate for cash. Weil's Superbank came to the rescue. Despite the telecom capacity glut, despite plummeting phone prices, despite Rubin's personal warnings, Citigroup led bank syndicates that sold investors $17 billion of WorldCom bonds.
In effect, you have the investing public giving money to WorldCom, which it then turned around and gave at least some of it to the banks, so that the banks' exposure from loans to WorldCom was either reduced or eliminated.
When they're floating the WorldCom debt offerings in 2000, 2001, Citigroup and these other big banks have a financial self-interest.
Well, in addition to the investment banking fees, yes, some of the banks were looking to eliminate some of the exposure they had from their loans to WorldCom.
And while Citigroup was limiting its own risk, its star analyst told investors WorldCom's plunging stock was now an incredible bargain.
At this point, as the stocks are starting to really get hammered, I'm talking to my broker 2 and 3 times a day to see what kind of damage control we can do here. When WorldCom got down below $10, it was like, this is a big company. Our analysts are still feeling good about these companies. They still have strong buy recommendations.
Good evening. We begin tonight with the most egregious case of corporate corruption.
Then the bombshell, June 2002. Charges of massive corporate fraud from inside WorldCom.
On the brink of bankruptcy.
We're not talking about a few pencils missing from the stock room. We're talking about $9 billion of earnings that were suddenly wiped out. And the investment bankers have an obligation to look for the signs.
The question remains, just what did Citigroup know about WorldCom's bogus bookkeeping?
Did you analyze everything, or did you just take their word for it?
No, we analyze it based on the financial results, stress testing the results, the reasonableness of their capital spending trends, their margin trends, their financial performance relative to their competitors. There were no red flags. Even the guy.
But Grubman knew WorldCom almost like an insider. In fact, he wrote emails coaching Bernie Ebbers what to tell Wall Street about WorldCom's finances.
But there's one particular email, Grubman is saying you got to talk about your accounting. And what does Ebbers do during the phone call?
First, accounting. Let me be clear, we stand by our accounting.
He actually ticks off the things that that he was told to say by Grubman. But
so he's in bed with management. Is that illegal?
Well, I think the fact that he's so tight with them raises the question of how he could not know about $9 billion in overstated earnings. And our lawsuit alleges that, at a minimum, he saw red flags and decided to ignore them as he continued to tout WorldCom stock to the investing public.
Not until April 2002, just weeks before WorldCom was charged with fraud, did Grubman drop his buy rating. And he never did say sell.
Well, I think the simple thing that we learn about WorldCom is if it looks too good to be true, it is too good to be true. What do we learn about Wall Street? We learned that they don't work for us, the investor. They work for the company, and it should be investor beware.
2 years of investigating the world of investment banks led New York Attorney General Elliot Spitzer to a harsh conclusion. Wall Street was riddled with abuses.
It wasn't just one corrupt individual. It was an entire business model that was flawed.
As you've gotten into this, are these issues complicated and difficult to follow?
It was incredible. It was distressing to me how simple and outrageous it was. It wasn't so complicated that you said, wow, at least they're smart in the way they're doing it. It was simple. It was brazen. The evidence of it was overwhelming.
Spitzer found damning evidence in firm after firm, but one celebrated case embodied the cynicism of Wall Street. It was not about WorldCom, but AT&T. And it reached to the highest levels of Citigroup, to CEO Sandy Weil.
Well, there's an interesting record on the AT&T upgrade.
Jack Grubman had long been a bear about his old employer, AT&T. But Sandy Weil, who had a cozy relationship with AT&T's chairman Mike Armstrong, was bullish on AT&T.
He felt that it would be good for the stock to get an upgrade, and he wanted his analysts to take another look at it. And he basically arranged for Jack Grubman to gain access to the AT&T hierarchy. And there was a fair bit of back and forth between Sandy Weil and Jack Grubman that led to Jack's changing his view.
Weil denied giving Grubman a direct order to upgrade AT&T, but bank records show Weil's relentless pressure on Grubman, who finally double-jumped his AT&T rating from a neutral to a buy.
After hearing it, I leaned back and said to Amy Elias, my partner, I said, Amy, there's got to be a banking deal coming. Why would Jack do that? And sure enough, AT&T announced a few months later that they were going to be spinning off AT&T Wireless as an IPO.
And who got the business, the banking business?
And sure enough, Solomon Smith Barney was the lead banker in the deal.
AT&T Wireless making a big splash today on Wall Street.
It was the largest IPO in history, raising more than $10 billion. Citigroup made more than $63 million on the deal. For 5 months, Frontline asked to interview Sandy Weil about his pressuring Grubman on the AT&T rating, about his bank's ties with Bernie Ebbers, and whether Weil's leadership permitted conflicts of interest and fraudulent recommendations that hurt ordinary investors. Sandy Weil declined to answer Frontline's questions.
What's the fraud that Citigroup and Solomon Smith Barney have been charged with?
The bank recommended a stock when it knew the stock was a bad investment. What was so revealing was this divide between the advice that was rendered publicly, wherein they said buy, strong buy, great stock, great investment, and the internal communications that made it eminently clear that these investments were not worthy.
Does the formation of superbanks increase conflict of interest that have the potential of hurting investors?
Absolutely. No question about it. There is no question that we have created a web of relationships that provide the opportunity for massive abuse. And what we uncovered last year demonstrates there was massive abuse.
Eager to get the scandals behind them, Citigroup and 9 other Wall Street banks struck a deal last December with Spitzer and other regulators.
It is time to close this, perhaps one of the darkest chapters in the history of modern finance.
The banks agreed to pay $1.4 billion in penalties. Citigroup's levy was $400 million. To get the bank's agreement, Spitzer had to make a deal. No criminal prosecutions.
Examined the evidence with respect to
Good news for Sandy Weil.
of the law, and there will not be any charges filed against Sandy Weil.
No charges against Jack Grubman either.
With respect to Mr. Grubman, there's a tentative resolution, a lifetime bar, $15 million fine, and that.
Are you saying the evidence was not sufficient to bring criminal charges against Jack Grubman or anybody else in the Salomon Smith Barney Citigroup hierarchy?
No, I believe that there are theoretical criminal cases that could have been brought. The judgment call that I have made is to bring civil resolution that imposes a financial penalty and imposes on the company the structural reforms that we sought.
There are many very carefully articulated rules that
Under the new rules, the banks agreed to stop IPO giveaways to CEOs and promised to insulate research analysts from investment banking. But the ultimate test is whether investors get honest advice from Wall Street in the future.
I want to see that analysts put out a sell recommendation on a stock that they brought into the marketplace.
And even Spitzer is not sure.
And I feel good about having moved things forward. There's a much larger question in my mind whether this will work.
Even those who cheered Spitzer's investigation say that the reform won't work because it's not tough enough.
It's really very simple. You have to separate banking and research. Period, the end. 2 separate companies.
We've had good rules for a long time, and the only thing that's going to make the situation get better is if those rules are enforced and they have bite.
People did things that are wrong, they should go to jail. It's just that simple.
And if they don't, then the message is...
It's the wrong message. That you can make multiple millions of dollars and dodge the bullet of breaking laws. That's ridiculous.
The Wall Street deal did little to repay investors. Spitzer released some key documents on Wall Street abuses, but it's now up to stockholders to file suit to recoup billions in losses, and the banks are girding for battle.
Is Wall Street fixed? Not by a long shot. What have they done to restore my faith and confidence as an individual investor? Zero, zip.
I still have the stock today. They say it's worth 14 cents, but I can't find anybody that would give you 14 cents for it. I still have it.
I have no faith and no confidence. Not in the companies, not in the brokerage firms, not in the people that own the brokerage firms like Citigroup. I don't believe in you. I don't trust you. I don't want a thing to do with you.
Bernie Ebbers, facing civil suits but no criminal charges, is living on his 2,100-acre estate. Jack Grubman was forced out of Citigroup and handed a severance package worth $30 million. Sandy Weil got a vote of confidence from Citigroup's board of directors, plus a bonus of $18 million in stock options.
This report continues on our website with analysis of the historic settlement with 10 investment banks and whether the reforms can fix Wall Street. More on the politics behind the rise of Citigroup and Wall Street's lobbying power in Washington. A chronology of the meteoric rise and fall of WorldCom. Frontline's extended interviews with Elliot Spitzer, Arthur Levitt, and others.
Grievously hurt by banks.
And you can watch the full program again online. Or find out on the website if your PBS station will be airing it again. Then join the discussion at pbs.org.